Welcome, everybody. Happy Wednesday to you all. My name is Andrei Knight, and this is Institutional Trading Strategies. Hope you're all doing fine. Hope you're having a good week so far. We're at about the midway point. And if it could be a little better, well, maybe I can share a couple ideas that can help you out going forward. My idea is I want to teach you guys how to approach this from a professional mindset. Professional mindset is not necessarily your choice of indicators. Okay, I have my personal favorites. A lot of them are actually taken from the institutional trading world. But I want to preface this by saying that I've seen about as many different kinds of charts as I've seen traders during my time in the banking world. I've even seen some trading desks without any charts at all, you guys. Long-term traders who just go off of the fundamentals. So it really doesn't matter whether you use moving averages or Ichimoku clouds, or even whether I color my moving averages red or green or purple. Okay? It's not so much the indicator, it's the mindset. Now I'll teach you some of my favorite indicators and tools as we go along here. But I wanted to stress that point. It starts with the trader and not so much the indicator. I've seen bad traders lose money even with good systems. And I've seen good traders make money even with very mediocre systems. So what do I mean by professional mindset? Well, it basically boils down to this. If I had to sum up the difference between an amateur and a professional, you guys, an amateur is always chasing moves. A price just moved up. I better buy. Oh, now it's dropping. I better close my long and sell. You're always chasing, and by definition, you will always be one step behind. A professional sets up scenarios. Okay, based on their analysis, likely things that'll happen. And then they simply sit back and wait for one of the scenarios to become activated, for evidence that one scenario versus the other is happening. So in other words, the trade comes to you instead of you chasing after it. Does that make sense? And I'll teach you guys exactly how to do that. And Ahmed, do I need a chat for day trading? Not really. Who am I going to chat with? I like to make up my own mind what price is going to do. And hopefully that's what I can teach you guys how to do today. To be self-reliant. Not depending on somebody else for your decisions. Okay, I set up a scenario, and I'll show you guys exactly how I do that. And I set up a trigger that would activate that scenario. And either it happens or it doesn't. If it happens, I open a trade. If it doesn't, I don't. If something else happens, I do nothing because that wasn't part of my setup for the day. You see what I mean? Already, I'm cutting my number of options in half. If I'm setting up a downside scenario and I get a long signal on one of my lower time frames, I do what? I simply ignore it because that's not part of my trading plan for the day. That's not what I'm waiting on. It doesn't mean you're always going to be right. I don't think any trading system in the world can do that. But what it does mean is that when you get into a trade, a higher percentage of them will be winners, and most importantly, you guys, the winners will end up being bigger than the losers. Okay, sometimes you win, sometimes you lose. But if one winner wipes out the last 5 losers, but overall you're winning more often than you're losing, what's that going to do to your account balance over time? The reason a lot of folks are struggling is because they kind of besides chasing price, they set themselves up kind of the opposite way. They have 2, 3 small winners and then one big loser that gobbles up all those profits and then some. Well, how are you ever going to get ahead? Exactly, Boyke. This webinar used to be reserved for FX Street Premium members. The admins, in their universal wisdom and kindness, have decided to offer this now as one of their free webinar series. So this is a real treat. I'm very happy to be able to talk to you guys. Listen up, take some notes. You meant a chart, Ahmed. For day trading, yeah, probably. But just so you know, with trading, it's quality, not quantity. Just because you're on a lower time frame and trading more doesn't mean you're necessarily going to profit more. A lot of the scalpers and really high-frequency traders I know, the really, really good ones, which are the minority, Ahmed, end up making roughly about the same amount of money, just with a lot more work. I haven't yet met a scalper who's making more than I am. I personally, for me, I like swing trading. I do a lot of my trading on the 1 hour and 4 hour charts. It's kind of in the middle. It's not high frequency trading. It's not long-term trades that you sit on for days and weeks. I like setting up my scenarios, executing them in the morning or afternoon, and being out of the trade at the end of the day. You know what I mean? Sort of like Goldilocks. It's not too hot, it's not too cold, it's just right. It's not too long-term, it's not too short-term, it's right in the middle. On a rare occasion, I might hold on to them multiple days. Commodities, this sometimes happens. But usually that's about the frequency that feels right for me. Your wife's a smart gal, Ray. All right, so let's dig into it. I'm picking on the Aussie dollar today, you guys. I like to take my examples from recent trading. Okay, because I like to teach hands-on, not just theory. We just wrapped up a trade here. We're getting ready to possibly enter another one. So I want to show you exactly where those ideas came from and how we set them up. And the reason I'm focusing on the Aussie dollar is because we just had a surprise interest rate cut. Everybody thought the RBA was going to leave it at 3%. They did a surprise cut down to 2.75%. And it caught everybody by surprise, except, well, George Soros. Apparently, George Soros made $19 million on this trade. But guess what, guys? It gets even better. He placed the same trade with 3 different brokers. So he actually became $60 million richer yesterday. It's not uncommon for Mr. George Soros. I hear he's made close to $1 billion so far on his yen trades. And it doesn't take a genius, you guys. The Bank of Japan said they were going to devalue the yen until it reached at least 100 against the US dollar, if not 110. All George did was act on it. No, I didn't. I've never met George. Not yet. I'd like to, Boyke. I'm good friends with his former partner, though, Jim Rogers. We exchange emails from time to time, but I haven't met George yet. One day. Okay, let me tell you a little bit about what you're seeing on the chart first, because we got to speak a common language before I can show you how the trade sets up. I'll just go over this real quickly for those that haven't been to one of these webinars before. I've got right in the middle of my chart a 21 exponential moving average. Okay, that's the purple line right here. Why 21? I don't know. There's, on a typical month, 21 active trading days. Forex is a 24-hour market, they say, but it's the most active 21 of those hours, if you add up the Asian, European, and American sessions. 21 is also a Fibonacci number. I could come up with all sorts of good reasons for you, but ultimately it's because I tried the 20 and I tried the 22. And I tried the simple and I tried the exponential, and the 21 in EMA works the most reliably. Very simply, if you're under the 21 and it's aiming down, you're in a downtrend. If you break above the 21 and then retest it as support, and the 21 itself starts aiming up, you're in an uptrend. And you're always either pushing off of, this is why I said retest, okay, because a break by itself is not enough. You're always either pushing off of the 21 or dropping back towards it. And that can happen above it or below it. Okay, one simple line, and already it's added a lot of clarity as to what price is doing. But then we fine-tune that. The lines out here are what are called envelopes. Some trading platforms call them channels. And this, very simply, is also another set of 21 EMAs. That's why I made them the same color. Okay? Also 21 periods, also applied to the close, also exponential, and then the only other variable you need is what's called the deviation, or in other words, how far from the 21 they are. And I think these particular ones were set by the weekly chart. Yep, looks that way. Okay. These were set by the weekly chart, and if you look at the right-hand corner, this is basically a purely visual setting, you guys. It'll change from day to day. It'll change from time frame to time frame. It'll change from currency pair to currency pair. It might even change from 8 a.m. to 2 p.m. Okay? You just have to keep an eye on it. And basically, you see what I did. I set the deviation so it kind of bypassed the first reversal right between the wick of the candle and the body of the candle. That's all I did. Try a bigger number, try a smaller number, but find the first reversal on your chart and bisect it between wick and body. And look, did a pretty good job of picking the tops up here. Look at the wick over here. It did an excellent job of picking the bottom down here. Basically, the purpose of the envelopes is to give you an idea of what's a reasonable area for the price move and when you're out at extreme levels and very likely to reverse. People often ask me, does this kind of work like Bollinger Bands? Not really, because Bollinger Bands will get wider if you push up against an edge. Well, what good is a limit if it gets wider or shrinks? You see what I mean? I prefer something that stays a fixed distance from the 21 for letting me know when I'm within normal trading range and when I'm out at extreme levels. And that's not a knock on Bollinger Bands. John Bollinger happens to be a friend of mine as well. But you got to use each tool for its intended purpose. John Bollinger started out as an options trader, specifically writing options contracts. To price a contract, you need to be aware of market volatility. That's why the bands expand and contract. It's meant for measuring volatility, not for finding reversal points. Okay? Just FYI. So I prefer a straight band. Envelope, DZ, like I said, it's check your list of indicators on your platform. If you don't find envelope, it might be called a channel, but it's basically the same as the 21 EMA, same settings. 21, close, exponential, and then like I said, the only other setting you need is the deviation. And the deviation is the distance that you simply set by eye. Find the first reversal on your chart and bisect between wick and body. And basically the idea is you mark one reversal, you have a way of predicting the most likely places for future reversals. And obviously if you start seeing a lot of reversals ahead of your envelope, shrink it. If you notice, like this was an exception, but if you notice all the time you're going outside of your envelope, widen it. It's purely a visual setting. And adjust as needed. It's kind of a guideline. It's not ultimately how I pick targets, by the way, DZ. I'll use prior highs and lows. I'll use Fibonacci. Things like that. This is more of a guideline for me. If I'm closer to the envelope than the 21 and I get a short signal, well, I'm going to think twice before entering because I'm much closer to the end of the move than the beginning. You see what I mean? Most of your trades are going to be taken from the 21 after a retest, remember, from the other side. But most of your trades are going to be taken out from the 21 out to an envelope, or if you reverse inside an envelope, back down to the 21. Okay? So it's just a way of kind of gauging where you are within the playing field, so to speak. And as you can see, as price moves, the playing field moves along with it. So it's always adjusting to the current situation. We'll get to that, Ahmed. Be patient. Let me finish describing the rest of the tools on the chart. Short answer is I trade it, my friend. Hopefully in the right direction. Which already you've got a very powerful tool for determining the correct direction of the trend, right? I said you have to be on the correct side of the 21 with the 21 aiming in the direction of the trend. DZ, as I've already mentioned twice, the deviation is set by eye. Find a reversal on your chart. Set it so the line intersects between candle body and candle wick. See that? See where the pointer's pointing? That's how I set this particular envelope. And then going forward, it did a pretty good job of predicting this reversal, and it nailed this wick down to the pip. Okay, couple other moving averages for you guys. I like the 50 simple moving average. And I like the 200 simple moving average. Notice now I'm using simple rather than exponential. You guys know the difference? An exponential moving average, they both average the amount of periods that you set it to, but an exponential puts more emphasis on the most recent candles. So it kind of weights it a little bit. My rule of thumb is anything under 50, I like exponential. Anything 50 and above, I like simple. And the logic behind that goes, first of all, I like contrast. I don't need a bunch of indicators that all show me the same thing. But if I'm averaging something like 200 periods, I'm obviously not concerned with the most recent price action, am I? You see what I mean? So long-term moving averages, I tend to go simple. Shorter-term ones, I go exponential because the most recent price action is critical. Adi, let me take a quick peek. Looks like 2.33%. But tomorrow might be different. Don't get married to that number. Different time frame, it'll be different. You gotta set it by eye. You see two more lines, you guys. Here are the little pink ones. See these guys? This is what I call the tunnel of fives. Very useful tool. This is a pair of 5-period moving averages. I like to use a smoothed moving average for this. It's a different kind of exponential moving average. Also puts more emphasis on the most recent price action. Just weighs it a little differently. The math is a little different from an EMA, but same kind of idea. And don't worry, if your charting platform doesn't have smoothed moving averages, you can substitute an exponential. They're pretty similar. Just in the case of exponential, there's usually a shift field too. I like to shift it 1. Okay, put 1 in the shift if you're using exponential. Smoothed, you don't need a shift. Okay, the only difference between this and a regular moving average, besides the type, usually moving averages you apply to the close. Okay, the closing price. Here, remember I said it's a pair of moving averages. I'm going to apply 1 to the highs and 1 to the lows. And that's how I create the tunnel. And this very simply for me, you guys, is a way of fine-tuning, a way of separating false starts from real ones. Okay, I like to do most of my trading on the correct side of the 21. Now, daily is where I set up my scenarios. I should mention I don't trade on the daily chart. Daily is good for seeing the big picture and for setting up your scenario for the day. I then zoom into the 4-hour chart and determine the current direction. Okay, no use waiting for a downside scenario if the current direction is up. You see what I mean? If I'm waiting for a downside scenario, I wait for the 4-hour chart to turn bearish, and then I go to the 1-hour chart and look for short entries. I use kind of a top-down approach. Doesn't mean I have to be a bear all day long. I'm allowed to change my mind, but I change direction only on the 4-hour chart, not on the 1-hour chart, which is how I avoid getting whipsawed by market noise and how I avoid chasing price back and forth. I only change direction on the higher time frame. I don't fall for the noise of the lower one. By the time I get to the hourly chart, which is my primary trading time frame, I already have a pretty good idea of what I want to do. I'm simply waiting for it to happen. Okay? But if I look, for example, at the hourly chart real quick, you kind of see what I'm talking about. Price breaks below the 21, retests it from underneath as resistance, but you see the move doesn't start yet. The real prolonged down move starts when we move outside of the tunnel of fives. Think of it as a noise filter. Sometimes it's bigger, sometimes it's smaller and squeezes together. Sometimes it's above the 21, sometimes it's below, sometimes it's right next to the 21, sometimes there's a gap in between. But the idea is it's kind of your noise buffer. Your good trades will happen outside of the tunnel of fives. And another thing it's really useful for, notice here we had a retracement to the upside, but then the down move continued. Not all retracements are a reason to exit your trade and abandon it. This one continued on. Here we retraced. You see that? And it took a long time before we came back down. The difference between this retracement and this retracement? This one stopped outside the tunnel of fives. This one, and I go by the bodies, folks. I don't care if a wick pokes in gradually, and then price comes back out. I go by where it closes. Okay, that's what I use for my decision making. So this one didn't close inside the tunnel of fives, proved to be a short-term retracement. The down move continued. This one closed inside the tunnel of fives. Take profit. Wait till we come back outside the tunnel of fives. And the trend continues. So it helps me wait till the right time to get into a trade, and then it helps to keep me in a trade and separate retracement from reversal. The indicators underneath my chart. Let me cover these real quick with you guys. Something probably nobody's ever told you about indicators, you guys. Most of them fall into one of two groups. Trend following, or sometimes called momentum-based indicators, and oscillators. Most indicators are one or the other. If you've had a favorite indicator, oh, I love this one, this works great. You tried for a couple trades, you're liking how it works, and suddenly it stops working. Well, what happened there? Did the indicator break? No, the indicator's still working the same way it's always has. What happened is the market conditions changed. Not all indicators work equally well under all market conditions. In other words, there's no such thing as one indicator that'll serve you all the time. The people selling custom-made indicators never tell you that. And as a matter of fact, I'm using fairly common indicators. Not using anything special or esoteric here. The difference is I know when to change which indicator I'm using. Therein lies the secret, you guys. My momentum-based indicators on top here, I like the OSMA personally. Okay, but you can substitute a MACD. In fact, you'll notice I use the same settings, 12, 26, 9 as a MACD. You could use a momentum indicator. There's actually an indicator called momentum. Anything from the trend following group. Okay? For my oscillating indicator down here at the bottom, I personally prefer stochastics. You get 2 lines instead of 1. But you could substitute the RSI. It's also an oscillator. The only difference is instead of 20 and 80, it oscillates between 30 and 70. You could substitute a CCI, commodity channel indicator. It goes from negative 300 to positive 300, but it's still oscillating back and forth between 2 levels. Do you guys get what I'm saying? You can put in any indicator you want here, as long as it's momentum-based. You can put any indicator in here as long as it oscillates, and my system will still work. In other words, it doesn't matter which indicator you use, as long as you know when to switch them. Just like the stochastics won't work any better or worse if you color them blue instead of green or red. When people ask me, which indicator do you like to use, I like to counter with, well, it depends on what color I color it. Because it works better when you color it a certain color. People usually look at me strangely when I say that, but literally. Changing indicators is about as useful as changing their color, you guys. Here again, it's the trader, not the tool. So what we need a way of knowing which indicator to use at one time. Maybe we should rename this class Forex Mythbusters. What do you guys think? For determining which indicator to use, I use a tool called ADX, Average Directional Index. And you'll notice I've grayed out the positive DI and negative DI lines. Normally this has 2 extra lines. I don't need them. Let me show you for a moment what it would look like if I had them. Because the ADX, you guys, actually falls into the trend following or momentum group. Meaning, I could actually get rid of the OSMA and substitute it with the ADX. Notice, when we're posting red bars, the red line, or the negative DI, is above the green line, or the positive DI. When we go to green bars, the green line is on top of the red. When we're forming bright bars, the lines get further apart. When we're forming dark bars, the lines get closer together. Because these indicators are both in the momentum group, they essentially tell you the same thing. They just look different and show it in a different way. You see that? 2 peaks, 2 peaks. What I use the ADX for is not those lines, okay? I can get rid of them to save on clutter. And because my chart is black, I color them black. That's how you get rid of them. What I'm interested in is the average line. And I put a cutoff at 30. I put a horizontal line at 30. What the average line of the ADX shows you is trend strength. Okay, it's not directional. Up doesn't mean long, as you can see. In this case, up means that the downtrend is getting stronger. And down means that the current trend is getting weaker. Notice it started going down when we went sideways. When we started dropping again, it started going up again. It measures the strength of the trend. See, back to the 2 different kinds of indicators, you guys. Momentum indicators are going to be your best friend in a trend. Because think about it. What do you need to know when you're in a trend? Is it speeding up or slowing down? Right? So in a trend, use momentum indicators. What good is momentum when you're in a range? In a range, you need to know whether you're oscillating up or down. Right? Whether you're in a bullish or bearish wave of that range. The default level, see Chan, 14. That's the default level that it comes with. And the cutoff is 30. I put a horizontal line at 30. So knowing that this measures strength, and to determine which indicator to use, we need to know if we're in a trend or a range. Very simply, my definition is, if your strength is greater than 30, you have enough strength to be in a trend. If your strength is less than 30, you're probably going to bounce around in a range. Because think of this. What is the difference between a trend or a range, right? There will always be support resistance levels, between your entry and your target. There might be a pivot, there might be a moving average, there might be a Fibonacci level. The difference really between a trend and a range, you guys, is whether any support resistance levels in the way bounce you or whether you break them. To break them, you need strength, right? Because by definition, a trend means setting higher highs or setting lower lows, right? To do that, you need to break past existing or prior highs and prior lows to set a higher one or a lower one. So to break through, you need a certain amount of strength. In my experience, greater than 30. If your strength is less than 30, very likely when you hit a prior high or prior low or some other kind of support resistance level, you will bounce. And when you're bouncing back and forth between two levels, we call that a range. Make sense? So a short way of putting it, and this is why I put the ADX in the middle between these two indicators. When it's above 30, I use this indicator. When it's below 30, I use this indicator. Make sense? And Ahmed, of course it's confusing. I've been doing this 20 years. You've been doing this 40 minutes, my friend. It's going to take a little bit of practice before it starts feeling natural for you. You know, I always make the analogy to driving. Remember when you learned how to drive? For me, it was pretty scary. You had to keep track of 3 different mirrors and all these buttons and knobs and watch out for somebody coming at you from all different directions. And you had to do all these steps just to put the car in gear and get it going. I had a lot to keep track of in my head, you know, and I was always nervous that I missed a step. But nowadays, you know, you drive pretty much without even thinking about it. You just think about where you want to go and you get there. And usually you can listen to the radio, talk on the phone. If you're a girl, do your makeup and all sorts of things at the same time. This is the same way. It feels like a lot of steps at first, but after you practice it for a couple months, or how long did you expect it would take to learn a new profession? After you practice it, you're not going to think about the individual steps anymore. It'll either be a good trade, you'll open up a chart and it'll either look heavy, or it'll look like it's about to take off, or it'll look inconclusive. And if it looks inconclusive, you sit on your hands and do nothing till you get more information. And also, you know, I never said you have to trade exactly how I trade. Take away what you find useful. For example, the idea that no matter which indicator you're using, half the time it'll fail you. And you got to know when you're entering one of those zones. You know what I mean? Or take the idea of being above or below the 21 to determine which direction the trend is going. Take away the stuff that's useful for you, throw away the rest. But I do want to caution you, any system is going to feel foreign the first time you look at it. It takes a few months to get proficient with any system. Okay, so that's the stuff on your chart. Now let's get into how I use it, you guys. Because we've been bearish on this thing even before the surprise interest rate cut. And I think there's probably a pretty good chance we might see more bearishness in the days ahead. How do I determine that? Well, look what's happening. We're below the 21. Right? Let's apply everything we've learned so far. We're below the 21. The 21 is aiming down. We opened today, or yesterday, I should say now technically, outside the tunnel of fives. Okay? Now, I want to point something out. You might be looking at this, and you might be thinking to yourself, what does he mean outside the tunnel of fives? The open of that candle is clearly inside. Be careful, you guys. Remember, the tunnel of fives is a moving average. Looking at it live versus looking at what happened yesterday there's a little bit of an optical illusion that happens. Okay, this is a moving average, which means it moves. We had a down day. So keep in mind the line moved down from where it was yesterday morning when this candle opened. Okay? The way to determine where it was at the open is you look at the candle before. This was on the tunnel of fives, right? We can all agree on that. This candle opened below where this candle closed. Therefore, wouldn't have this opened outside the tunnel of fives at the time. You see what I mean? When you're studying a historical chart, go by the close of the candle before to determine the open of the candle you're studying. I was trading this live, so I remember it opened right underneath the tunnel of fives at the time. More interestingly, look at the open of the current candle. Once again, we opened outside and below the tunnel of fives. Or, pardon me, outside and below the prior candle's close. That's what we call a bearish candle open. Okay, so price action suggests to me more bearishness ahead. ADX is below 30, so I'm going to look at my stochastics. Oh, will you look at that? Red over green. 2 days ago, they looked like they might want to touch and possibly cross. Now they've opened back up and they're getting wider apart. That tells me more bearishness ahead. So I've got bearish price action confirmed by the oscillating indicator that ADX is currently favoring. See what I mean? So Ahmed, it feels like a lot of lines and a lot of steps, but think of what the chart is saying when I put it into plain English. We're below a 21 that is aiming down. We have a bearish open outside the tunnel of fives, and the indicator that ADX is favoring is bearish and getting wider apart. You see what I mean? When you think of it in terms of what story is it telling you, instead of thinking of it in terms of it's just a bunch of lines, you actually see that it makes sense and there's a reason for each indicator. Let me say it again. Let me talk through it for those that missed it. We're below the 21. It's aiming down. We're outside the tunnel of fives and had a bearish open relative to the prior candle. And the indicator we're currently favoring is bearish and getting wider apart, which means getting more bearish by the minute. That's not complicated. I said that in about 10 seconds. But what I have now is a complete picture of what price is doing. Well, Chuck, matter of time frame. Okay? At the moment, I'm expecting an up retracement. Yes, I didn't get to that part. You're preempting me. This is a daily chart. I'm planning my scenario for the days ahead. Actually, at the moment, I'm not doing anything. I'm going to teach this webinar, and I'm going to call it a day. I don't like to trade during the slow part of the day. But long term, if this thing continues dropping, let me explain why I'm bearish over the long term, Chuck. Okay? Let's draw a horizontal line at the prior low. Okay, because as soon as I come up with a scenario, our next job is to test that scenario, or test that theory, to determine if we can act on it or not. I kind of liken us to scientists, Chuck. You know, what does a scientist do all day? First they devise a theory, then they come up with a way to test that theory. And if the theory tests positive, it becomes fact, or in our case, a trade. If the theory gets disproven, you got to come up with another theory, or in our case, another scenario. So my theory is that we're going to go lower. I need a way to test that theory. Very simply, I put a line on the prior low. And notice I'm going by the bodies, not the wick. I'm interested in consensus. Okay? What leads me to believe, or how I'm going to know, let me say this, how I'm going to know if there's further lows ahead, we've broken that support line, which is unusual, especially considering ADX is below 30, right? We actually, in theory, shouldn't have the strength to break this line, which makes this break that much more exceptional. If we can now hold it from underneath as resistance, that's when I know it's time to short, Chuck. Okay? I'm not shorting yet. I'm shorting when I establish resistance here and turn down below this line. And what leads me to believe there might be more lows ahead, going back to my envelope, there's room for it. Okay, if it was a reversal at the envelope, it'd be different. We're also yet not inside the tunnel of fives. So my alarm to trigger trend is over has not been sounded. And to determine how much further it should go, I like fibs personally. I draw a fib from the top of the preceding downtrend to the bottom, and in this case I'm going wick to wick, because now I'm measuring distance, not looking for consensus. This was a 38% retracement. In theory, this could go as low as 138, which is 1.0082. So basically, long term, okay, not right now in the next hour or two, but long term, the trade I'm basically looking for would be if we establish this as resistance, looking to trade from 0.192 to 0.082. Okay? This will be the trade when the trigger for it goes off. And the trigger, Chuck, would be the 4-hour chart turning bearish, and then the 1-hour chart giving me a bearish entry signal while the 4-hour chart is bearish. So yeah, as you correctly said, right now is not the time to act on this scenario. It's a longer term scenario. Right now we're in the process of testing this as resistance from underneath, which means, yeah, we're moving up. And conceivably, on a lower time frame, I could probably take a long trade up to this level. Absolutely. That's a matter of time frame, it's a matter of sequence of events. Okay? But after that up move is over, this is the down move I'm expecting. Now, I mentioned you're not correct 100% of the time. At some point, I may need to revise my theory to be long-term bullish. What would it take for me to do that? Well, maybe a divergence on the daily chart, which this is not a divergence yet. I need a dark bar, right? In theory, I could keep posting longer and longer bright bars until it's no longer a divergence. I only know it's a divergence when I get a dark bar and when it closes that way. Okay? So I would need a divergence. I would need the indicator that ADX is favoring to turn bullish. And just like I'm looking for resistance here, I would turn into a long-term bull if I break above this line and close above it, and then come back down and establish it as support. That's the point at which I would go from looking for short trades to looking for long ones. And then I'd probably trade a return. Can you guys guess? If I find support here, if the indicators are bullish, what would be my upside target? I kind of gave you a hint at the beginning of class. Anyone guess? Great guess. TLM affiliates, not quite. Tunnel of fives determines retracement versus reversal, determines noise versus trend. 21, you got it, Cody. Because remember what I said, you're always moving away from the 21 or back towards it. So if I have to abandon this fib early, 0 probably will happen, Chuck. The 0% fib he's referring to, which is the prior bottom, right? Support as a way of becoming resistance. But probably what would happen, Chuck, remember, I don't need to be just above this line. I need to test it from above as support. So probably the way it would go on an upside reversal is we would come up above this line, find resistance at 0, then come back down and give me that test as support as I need. And that's the point at which I would enter. And at that point, we would have already touched 0, so probably the 21, a return back to the 21 would be the next conclusion. So this would be my backup plan, okay? Plan B, if you will. But I don't have the signals I need in order to activate that scenario. Therefore, I'm still waiting on this one until something changes. But the key word is waiting. Being that it's the Aussie dollar, I would expect it to move either during Australian session or during U.S. session. U.S. session is currently drawing to a close. Australia hasn't started trading yet. So time of day is not good, and I don't have that confirmation yet as resistance. As for your upside trade, Chuck, I think it was a pretty good idea at this point when the divergence formed. You could trade a return back to the 4-hour 21, but be careful right now. You had a doji under the 21. You had a bearish open relative to the cross of the doji. And you're within the tunnel of fives, which means you're kind of in the noise zone. Okay? I think it might have been a good trade from here up to the 21, but just be careful. This might be a little prone to sideways chop at this point. Just from the looks of things. I think if anything, look at the hourly chart. You kind of completed a move to its 50 moving average, bounced off of it, and came back below the 21, even opened outside the tunnel of fives. ADX below 30, bearish stochastics. I think the move you're talking about is already completed. The rest of the day, we might just kind of range between the 21 and one of these prior bottoms here. Just from the looks of things. And Cody, something I should say about the tunnel of fives. Remember, because it's a trigger for entry and potentially also a trigger for an early exit ahead of target, I would consider the tunnel of fives primarily on my primary trading time frame, which would be the hourly chart, not the daily. Waiting for resistance to develop, Diana? Absolutely. We're kind of seeing it here, actually, now that I think about it. This is that line that I drew on the daily in question. Notice these candles. They span it, right? This line is neither support nor resistance. Price is kind of ignoring it like it's not even there. Same thing here. The bodies span it. Notice here, it acts like a shelf or a ledge. The red candle came down and stopped right on it. The green candle opened right on top of it and moved up. So here we established it as support. Okay, and this was probably the move Chuck was eyeing, but notice the 50 moving average stopped it cold. We couldn't break through this and turned back down. On the way down, instead of finding support at this line, we came down below it. Notice the wick of the green candle. We were down here. And then we came back up, and now we've established this level as resistance. Does that make sense? Here it's acting as support. Here it's acting as resistance. Here it's acting as neither. It's just noise. We can't draw a conclusion. Sid, it's a pair of 5-period moving averages, smooth moving averages. If you scroll up in the chat window, you'll see it. It's a pair of 5-period moving averages, one applied to the high, one applied to the lows. Ray, you were asking if I have a signal service based on this system. Not so much a signal service per se, because my opinion, A, a signal service breeds dependence, doesn't teach you how to think on your own, and B, even the best signal services I think are of limited use, because I may give the signal at 2 p.m., you may get it at 4 p.m. I might be exiting right around the time you're entering. I think you're far better off learning how to make decisions on your own. In other words, generating your own signals, which is what I teach people how to do. What we do in my program, we meet at the beginning of the trading session, and just like we did today with the Aussie dollar, we set out our trading plan for the day. I'll tell you which pairs I'm watching, why I'm watching them so you can learn, and what the trigger event will be to activate that scenario. Then I leave you guys to trade on your own for a couple hours, and we meet again at the end of the trading session, and we compare results. What worked, what didn't, what can we do differently or better for the next day. And we do that every trading day, twice a day. And I think it'll get you much further than a signal service will. Okay? And if you're interested in finding out more, I posted a link in the chat window. And by the way, it costs far less than a single losing trade. Most of my traders, with one trade, maybe two, pay for a whole month of training. Hope this has been useful for you guys. Please join me a week from Friday. Or actually, no, we're not doing it this time around. Please join me on the 16th of May. We've got a special webinar. It's going to be a whole day devoted to volatility. There'll be lots of great speakers. I hope to see you then. Thank you, admin. If you want a list of my current webinars, you'll find it at that link. Have a great day, everybody.